Are ETFs an efficient alternative to active funds in the high yield space? The active-passive debate has been a recurring event ever since the launch of the first exchange-traded funds. As a low-cost, index-tracking alternative to active funds, passives have been gaining in popularity across all asset classes. In the high-yield bond area, passive solutions in the Euro high-yield bond and US dollar high-yield bond Morningstar categories already represent market shares of 15 and 11% respectively. In both cases, iShares is the dominant provider. Against a backdrop of increased popularity, it becomes important to assess if high-yield ETFs truly are the efficient alternative for active funds that many investors hold them to be. For example, how feasible is it to replicate the high-yield market and passively track it? And more importantly, can a passive approach to high-yield deliver excess return over active peers in the long run? For this analysis, we'll focus on the two market-leading iShares ETFs, as they also hold the longest track records: the iShares Euro High Yield Corporate Bond ETF and the iShares US Dollar High Yield Bond Corporate ETF. In terms of performance, both ETFs consistently land in the third return quintile of their respective categories, but even on a risk-adjusted basis, as measured by Sharpe ratios, they fall short of consistently beating their category averages. In terms of price, both ETFs come with an ongoing charge of 50 basis points. And although not being the cheapest passive options, they're nonetheless priced very competitively against the average active high yield fund. So even despite a clear cost advantage for high yield ETFs, these generally fail to outperform category averages. The generally illiquid nature of the high yield bond market has created important replication challenges for passives. Some of these issues have been partly addressed at the index level by focusing on the most liquid parts. On the one hand, this has facilitated replication and improved tracking ability. However, on the other hand, this focus on liquidity has come with an obvious downside, namely that of not providing a comprehensive representation of the market. Ultimately, this means that high-yield bond passive funds fall way short of mirroring how active managers position themselves in this space. As a result, experienced and well-informed active managers can successfully exploit the opportunities overlooked by indexes to add value, for example by tapping into the smaller cap or riskier spectra of the issuer universe. All in all, high-yield bond ETFs do what they're supposed to do, that is, track their benchmark at low costs. Ultimately, however, this is an area where the value of information and the flexibility of non-benchmark tied mandates seem to provide a clear edge, which is why the largest high-yield passive funds in the Euro and US dollar high-yield bond Morningstar categories are awarded a Morningstar analyst rating of neutral.